Dinshaw Irani is ready. Let's connect with him. And I can bet that doesn't matter how volatile markets are, he will be bright and chirpy, and this time it's a yellow t-shirt. Just a coincidence, or this is like you're confused, not here, not there. Red is bulls, red is bears, green is bulls. Yellow means not
Yeah.
here, not there. Yellow means volatile actually. Let me rephrase it. The new market color.
So because I was anticipating that question of yours, and I realized that since I was wearing a yellow T-shirt and it's on amber, by the way, it is either ways. You can move either ways. You can wait for the market. Actually, we've been calling this out. We've been saying that the market's gonna be in a tight band, and a correction will be an opportunity to pick up your stocks where you're comfortable with, and a real rally, if there is one, you may just shave off a bit and then come back again, and because there's enough opportunity in this market actually, and that's what we believe ourselves to be stock pickers. So we waiting for the right stocks and the right price and
Sharma also joined us. He was wearing a yellow t-shirt. When I asked him the same question, he said that is my idea of how I want to represent India. See, if you can see Shankar was wearing yellow, you can wearing yellow. Like sun is shining bright.
that was a good answer.
So, have you shopped a lot in this market decline? Because a lot of news per se will not have impact on India, if at all. If I focus on crude, so what's happening in the world right now? A, it's not going to have a contagion. B, crude and commodity prices have come down, which on margin is great news for us.
So actually, Nikunj, the problem that US went through, the banks went through, it was quite ironical, right? And because 2007-8 was brought on by aggressive lending to the housing sector, which actually the bubble burst and things went downhill for them. But in this case, it was because of buying government bonds, right? So it was obvious there's not a crisis we're talking about. At the most, a Fed could have very well come back and said that, okay, guys, I will lend you the money on the face value of the bonds as such, because he's the guy who's issuing it, right? So, and that actually happened, and that's why the world is back to where it was earlier. And actually, you're right, because we did realize this, and frankly, I mean, we never panicked. We did pick out a few names. I mean, not names, rather we didn't add any new names, by the way. We've been in search for a few names, but we did add to our existing positions and never cashed out. And we, in fact, we were in cash to an extent, and we started deploying that cash to that much extent. So.
So we're never happy with just the view. We want the names as well. What is it that you bought and sold?
Aisha, no, I won't be I won't be telling you the names per se, but I'll definitely disclose the industry. So basically, the panic was in banks, nothing to do with US, and certainly you saw a lot of correction in the banks in India per se. So obviously we love our private sector banks, and so we picked up a few names there. In the consumer space, there was a bit of a upheaval because rural seemed to be not picking up, urban seems to be on a downhill. So that's why one sees a bit of a turmoil, which we agree with also to an extent, but we don't think that's going to be a lasting effect. So there we're being a bit cautious, but we're picking up wherever we see value coming in as such. So.
Okay. Dinshaw, so maybe you're not divulging too many names. So let us try and eke it out of you and just chat individual sectors actually. And wanted to get in your take then as to what the outlook is. I'm asking in particular within the defense space, because that has seen a lot of news flow of late. Some positive news as well coming in for the likes of BEL as well as HAL in today's trading session. That's a space that, y'all have looked at. So what's the interest in terms of picking out stocks within defense? And do you believe that it's a long-term theme that investors can ride out?
So we're being very choosy out here because we also believe that I won't say long term because all depend on the budget flows and stuff like that. But frankly, I mean, the ones which we looked at were mainly as outsourcing plays rather than purely on the defense budget of the country as such. Though that is also a big thing to look at because you're talking about indigenization happening on a bigger scale as compared to what was earlier. But the fact is that you need to be in a sector, in a stock, which is not only dependent on the budget flows as such, but also on global flows per se. So that's why we are in a space which is in electronics, in the defense space, which is into electronics. And as you rightly know, electronics are used across the forces as such. It can be Navy, Army, or Air Force, or whatever you will. And obviously, it's a very appealing space, even on a global scale. So that's why we're being very specific here. We're not being spreading our bets in this space much.
I'm looking at the screen, and today the price action I think is very, very commendable. So, Dinshaw, I'm going to address the big global concern. The big global concern was that US financial market and then the European banks will go belly up. The regulators have stepped in and they are following this approach of whatever it takes to stem the crisis. So surely if one has to address the big elephant in the room, which is confidence and crisis of confidence, has that got addressed? Do you think there is no fear of contagion or any bank going belly up now?
Not really, Nikunj. As I said earlier, also this time it's a different problem. It wasn't a problem where there was aggressive lending. Actually, your asset side is not the one which is sorry. The asset side is not under question out here. So basically, what you're doing is what they did was they bought into these government bonds, and as because I mean, frankly, I mean the interest rates were in such levels that a good yielding asset was a government bond per se, and that's what give them a very good return in a flattish interest rate scenario. But as the interest rates started moving up, that is where they started taking a hit. And as I said, that's a very easy problem to solve because it's a sovereign debt you've got in your hands, in your hands as such. And obviously it's the central bank can easily bail these guys out by saying that, okay, I'm lending you against the face value of the bond that you're holding. And that's what really happened. And that's why I don't think it's a crisis per se, but yeah, as you said, the confidence levels were the ones which were taking a hit. And I think the way the banks have behaved in the US also, like 11 banks came together to bail out First Republic Bank per se, and gave them a deposit of $30 billion just to tide out the run on its deposits. So I think that's a very good move that these guys are doing, and they're also comfortable here. It's not an industry which has blown up, which used to command a big chunk of their book as such. So that's where the comfort comes from.
Problem number one, there is no fear of contagion. Now let's address the second problem, which is that from inflation, the narrative is shifting to recession. Bond yields are down, commodity prices are down. So we may say, okay, bond yields are down, crude is down, that's great news. But if recession is knocking on if is knocking now, that means that the second half we could be in for more earnings downgrade, more disappointing economic data, and then what will happen to a market like India, which is a premium market?
So, Nikunj, if I were to share some data with you, in the last 50 years, this inversion in the US has happened 9 times in history in the last 50 years. Okay, 8 of these times it has led to a recession. The 9th time which is yet to happen, is October of 22 when the inversion happened. But the good part is that the last inversion was in 18, and there was a recession which came in, but it was a very limited time period recession. And the only comfort that you take away from that is that Mr. Jerome Powell was the Fed chair even then. So that he knows the battle. He's fought this battle. He's won it earlier. So that's one comfort level coming in here. The second one is the fact that we're looking at so the recession had to be called out, right? Because the inflation, the way it was running away, I think the Fed also was looking at it. But the silver lining here is the way the banks are now getting stressed in the US, it's obvious that the Fed also will take a backseat and say, okay, I've done enough, I think. Let me wait for the data to come. In fact, the retail data, which has been coming out on a monthly basis, the last 4 months, 3 months have been negative in the US, the retail data as such. So it's obvious that they are already in a recessionary cycle. I think he needs to limit it to that extent. So maybe that is what is happening. He will not call out a 50 bips hike. Europe did, ECB did as such, but then they were very, very much behind the curve, right? At 10.5% and 3% of interest rates. I mean, come on, 10.5% of inflation and 3% of interest rates. I mean, there was a no-brainer there. So I don't think it's going to happen here. Even on the inflation front, they're somewhat in control, though too far away from the comfort levels of 2%. But I don't think it's going to be a panic situation going forward. And as you rightly pointed out, recession is around the corner, no doubt, in the US. But in India, I don't think that's going to happen. Our belief is that even RBI's rate hikes were not to control inflation. It was mainly to counter the US Fed rate hikes and manage the rupee per se, rupee USD depreciation per se. So that's what was happening out here. And even here, though there may be some kind of crisis of confidence in the sense that retail may take a backseat per se, but look at the way the capexes are kicking in as such. I think that's going to work out perfectly for us.
had interesting new sort of notes and observations on the entire India urban consumption patterns, right? I mean, everything from a Vedant fashions to campus footwear, or for that matter, even lemon tree. Tell me, in the current macro environment, do you see the rich tightening their purse strings? Because, I mean, data doesn't seem to be indicating at all. We just heard from DLF yesterday as to how their new premier property is already selling like hotcakes.
Right. So 8 crore ticket size, 1100 odd units sold. I mean, 8,000 crores in the kitty. See, these are mind-numbing numbers, right? So the fact is that I don't think the rich are impacted as much. In fact, even today, you can hardly find any. There are luxury watches as such. There's still a waiting list for all the luxury cars and also. So I don't think that's a segment. Anyway, that wasn't the segment which was moving the ticket in India. It was mainly the mid and higher mid income which was really doing the job out here. But the fact is that, yeah, I mean, this segment itself is going to grow, right? And that's where the call is. So maybe in the short term, maybe one may see some kind of a small downtick or something in this space. But the fact is, on a longer term basis, medium to longer term basis, this is a space you need to be in, because if you're calling out that India is going to be the third largest economy by the turn of this decade, then obviously this is the space which is going to be the one which is contributing to that, right? So that's why you need to be there on a regular basis. In fact, look out for your ideas, and as and when you see some opportunities, get into them and keep building up your positions.
DLF folks were, in a sense, indicating that this time around, a lot of ultra HNI investors from Bombay, especially from market, have bought place, have done a booking there. I'm just saying it. I'm not saying you bought it. I'm just telling you.
Okay.
Why you
so
not
even I heard that. I wasn't the one.
I'm just saying it. No names.
Come on, Nikunj. He's not HNI. He's almost an FII.
That's ultra
Right,
HNI.
Dinshaw?
Ultra HNI.
I'm sure
Net
Nikunj
worth
was
wise.
the one.
Dinshaw, but is there merit in buying real estate? Because typically, if we are going through a shakeout, and if there is a bit of an volatile environment for equities and for financial assets, real estate and hard assets, they come back. Money could move away from equities to real estate, from equities to fixed income. Is there merit in thinking on those lines?
Nikunj, there may be some merit here, but the fact is, when a rising interest rate scenario, you normally stay away from interest rate sensitives, and these are interest rate sensitive because you're talking about big ticket EMIs out here. I mean, as in whenever there's a slight hike in interest rates, the outflows also increase to that extent too, because most of the lenders were telling us that they're already at 15-year tenure level. So it's now EMIs which are going to go up and not the years of payment coming back to them. So the years of EMI, sorry, coming back. So that's why I believe that this is a space where you have to be very selective. In fact, we've been very selective out here. We've just got one single name, which is a metro-centric company, and obviously there's a mix of retail, a mix of rentals, and stuff like commercial rather. So that's what we're playing here. And because anyway, the commercial part also gives up as the interest rate cycle moves up. So that's what we're trying to hedge out here. And that's why we've been very selective.
You don't own IT. But is it the time when you should revisit IT? Because most of the IT companies have said that, look, we've got no problem with what's happening in the world. We don't have exposure to the banks where there is a problem. Now that if your thought is that banks will not have a big problem and IT stocks have sold off because of that concern, so if the concern is not real and prices have gone down, isn't it this time to revisit them?
Not really, Nikhil. I think this is the time you need to be. In fact, any rally you should use to get out of IT per se, because our belief is that, in fact, if you look at the sound bites also which came out of NASSCOM, they weren't very gung-ho about it. In fact, after seeing a dip from 19% to 11%, they're still talking about a slowdown in FY24 as such. In fact, the year of excesses is coming to normal. I mean, that's what the word they used as such. So obviously that is one area of concern. Secondly, if you look at the recent surveys that are being done by CTOs, it's obvious that they're looking at cutting off. In fact, if you now talk to some of the IT players, you'll yourself realize that they're getting more and more cautious as what they were 3 to 6 months back. And obviously, one is going to wait very anxiously for what Infosys declares in the March end and gives the guidance for the year as such, we don't believe it'll be more than any mid-single digit kind of guidance as such. And frankly, I mean, if that is the way it's going to be, your valuations might as well come back to the pre-COVID levels when anyway the growth rates were mid-single digit kind of growth rates per se. And that, you know, that they are still around 25 to 30% away from those, even despite the correction that one saw in the IT sector.
All right, Dinshaw, appreciate your time. Thank you for joining us, and keep that smile going, Dinshaw.
Always a pleasure, Nikunj. Always smiling for you.